Well, welcome everyone to the BetaShares Legg Mason webinar, Are Emerging Markets on Your Radar? Thank you all for making the time today to join us. We welcome everyone from across the country and taking the time away from, I guess, running out and buying toilet paper rolls like everyone has been doing lately. So I'm joined here today with Andrew, but before we get into that, I'll get a bit of admin out the way first. So the all-important slide here, again, what we'll be talking today about is very much general advice only. It doesn't take into account anyone's personal circumstances, and we always do implore people to seek professional advice before investing. And the other one I'll highlight there is, of course, is past performance is not indicative of future performance as well. Also today, this will be a recorded webinar, so if you miss anything and want to go back, this will be getting sent out, or if you know anyone that couldn't attend today, you can let them know that they can find this online. And also we will be taking questions as we go along. You can see there's a wee widget box which you can write your question in there, and we'll make some time at the end to answer those. And also I'm actually just going to pop up a quick poll question now for you. So as you can see there, we just want to know, which emerging market country do you think has the best outlook over the next 12 months? Just give a few seconds there for everyone to answer. So we've got China, Taiwan, South Korea, India, Brazil. Okay, we've got China in the lead so far, like India. And it's India. So that's interesting. We'll definitely see if Andrew also believes in that. And why I just mentioned him, we are very fortunate today to have Andrew Mathewson, one of the portfolio managers from Martin Currie, which of course is part of the Legg Mason group that managed this emerging markets fund. Welcome, Andrew.
Thank you.
And myself, Chris Yates, I'm a director here in the BetaShares business and the advisor business for New South Wales ACT Advisors. In terms of the partnership with Legg Mason, we have a great partnership with them and have many of their funds available to our investors. Legg Mason, of course, is a leading active manager with over 1.1 trillion in funds globally, and they have 9 independent investment managers spanning all asset classes. And as you can see down the bottom there, we have listed a number of their funds in terms of BNDS, which is a part of the Western Asset, and of course the 3 Martin Currie funds in terms of Real Income Fund, Equity Income Fund, and of course what we're talking about today in the Emerging Market Fund. And us as BetaShares, we are a leading ETF fund manager with over $10.5 billion of fund under management, and we offer the broadest range of ETFs on the Australian market. So in terms of the agenda, what we'll be talking about and covering today, we'll be getting Andrew to talk about the macro outlook in terms of emerging markets. I believe he's going to touch quickly on the coronavirus as well, obviously very topical, and also the EMMG's investment strategy, how they actually construct and look at that emerging market space. And at the end, I'll be finishing up just covering, I guess, the access point and how we're seeing investors use this in their portfolios. So over to you now, Andrew.
Okay, thanks. Good morning, everyone. I'm down here in Australia for a week, so it's fantastic to have this opportunity to speak with so many of you this morning. I'm just going to talk a little bit to start with about the opportunity in emerging markets, and hopefully I'll bust a few myths about what the opportunity set is. So let's get straight on with that. I imagine most of you will be familiar with the fact that emerging markets have stronger growth, and that's true, and that is part of the opportunity, but there's much more to it than that. We've also got expanding populations, but really it's about urbanisation, and as people move from rural living to city living, that's where really in the stock market you can take advantage of that consumption change that's taking place, and we'll talk more about that as we go as well. Then there's also some very strong secular trends that are taking place in emerging markets. I mean, one example of that would be the phenomenal success of mobile commerce in China. In 2019, online retail transactions reached nearly $2 trillion US, and that figure is only $600 billion in the US, despite the fact the US population is almost fully online. So that's just a small window into understanding that emerging markets are starting to take the lead in many areas. And these trends are very long-term and are going to continue for many years to come. Which takes us to our next point, that investing in emerging markets is not just about that faster growth. It's today, investing in emerging markets is about accessing some of the global leaders in innovation. And we'll talk more about that as we go as well. So, middle-class populations in emerging markets are expanding. And you can see in the charts here some of those numbers, and it puts into context the scale of what's taking place, about the number of people, the billions of people that are entering into the middle class. And that shift is taking place across all the markets that we look at. But let me just pick out what's happening in a couple of those. In India and China, in the next 30 years, we're going to see the urbanization of over 600 million people. And it's these people who go from rural living to urban living that start to consume and they start to interact in the economy in a way which we can harness in the listed equity business. So for example, they start not just using bank accounts, but maybe buying life insurance or health insurance, or maybe even dental insurance. They start looking at leisure and education. They start dining out. They start going for coffee. All these things are areas where we're accessing through the listed stock market. And that's really the powerful driver of the demographics in emerging markets. And that's what we can harness in the stock markets. On to the next slide here. What we're talking about here is the changing nature of emerging markets. And this is where I want to bust a few myths. People think of emerging markets as being this sort of high growth, but also being this risk trade. But what we've seen is a huge change in the underlying makeup of the index. So in emerging markets, historically, even 10 years ago, you had over 30% of the index made up of energy and materials companies. So in essence, the USP of emerging markets was that it's cheaper to dig stuff out of the ground in emerging markets than it is elsewhere. And we've seen a big change in that. Materials and energy is now less than 15% of the index. That's actually in line with what you'd see in the developed world. Today, emerging markets are dominated by financials, by consumer businesses, and by information technology businesses. So let's take each of those in turn. In the financials, what we're talking about here is probably the kind of financial businesses that we were used to in the developed world 20 years ago. Banks that take deposits and lend on mortgages with a good spread, consumer lending with a good spread. And increasingly, as people are becoming wealthier, they're not just buying mortgages or consumer finance, but they're also looking for their wealth to be managed. They're looking for insurance products as well. So it's a big cross-sale opportunity. So emerging market banks still have, that traditional opportunity, and the growth rates are sound. Then in the consumption space, we've talked a little bit already about the evolution of consumption in emerging markets. So historically, a lot of emerging market portfolio managers would have talked to you about the consumer staples opportunity as people in emerging markets are going to buy toothpaste or deodorant. Those trends are really mature now. Now people in emerging markets are looking at how they're spending leisure time. They're buying cosmetics products from South Korea that cost $200 for a pot of skin cream. They're buying education for their children. They're looking to go on overseas travel. They're looking not just to buy their first car, maybe to buy an electric vehicle. So we're seeing this big change that's taking place in the consumption patterns, which goes hand in hand with that rise in the middle class of emerging markets. And probably the most exciting, the most interesting is information technology. If you take information technology on the slide there, but also communication services, which is where the internet companies are based, you can really see that tech part of the index is the largest sector in emerging markets. And here we've seen a huge transformation. 10 years ago, 20 years ago, the technology companies in emerging markets were assembling the laptop that you've got. They're assembling the phone that you've got. Whereas today, companies in emerging markets are the ones that have the intellectual property in those products. So whether it's the screen in your smartphone, whether it's the camera and the camera module, maybe it's the memory or it's the processor. Emerging market companies don't just make these products, but they have the R&D and the intellectual property behind those products as well. And that means they can take a higher margin for that business. These are higher return, higher growth, higher cash generative businesses. And so that's all part of this huge transformation in the index that we've seen in the last decade. And I think this is a point that hasn't been recognized by many participants in the marketplace. Which takes us on to the next slide, which is the valuations. Emerging markets trade at a substantial discount to developed markets. We haven't seen the re-rating take place that we have in emerging markets, in developed markets. And let me just walk you through a little bit about the story behind that. What we saw was big excitement about the opportunity in emerging markets before the financial crisis, and valuations between EM and DM converged. And that actually held right through the financial crisis until about 2011, 2012. And then what happened was EMs in many ways weren't impacted in the GFC in the same way, and companies still had a growth opportunity ahead of them, and they continued to invest heavily for that future. And what happened was, although emerging markets continued to grow, the growth disappointed relative to what was happening in the developed world. And companies in the developed world were doing the exact opposite. They were not investing at all. They were paring back costs, and actually growth surprised positively versus expectation. And as a result, you had margins expanding across the developed world. Combined with that, we saw significant buybacks and leveraging up of developed market balance sheets, which further drove the markets. And we've seen this big divergence open up between the developed world valuations and the emerging world. And meanwhile, that emerging market index was changing shape dramatically, and as we've talked about, was improving significantly, and yet we haven't seen any re-rating in emerging markets. And so you can see that it hasn't always been the case that emerging markets are traded at this discount. And so there are a number of reasons why that could change. And actually, in 2017, we saw emerging markets put a significant rally and outperform and started to close the valuation gap. But then a combination of the US Fed attempting a normalization path on interest rates, then the US fiscal giveaway, which sucked dollars out of the rest of the world, and then finally the trade war kicking off, really impacted on sentiment for EM. But where we are today, well, the Fed path of normalization is completely dead. That US fiscal giveaway we've worked through, and we've seen the signing of the phase 1 trade deal. And perhaps the most important aspect of that was around currency, where both the US and China agreed to no further devaluations in their currency. And the Chinese yuan devalued about 13% through the teeth of the trade war negotiation. And so that was a significant headwind for emerging markets. So with those things behind us and the expectation that emerging market earnings growth was outstrip the developed world, it looked like 2020 was set to be a very good year for the emerging market asset class. And then we find ourselves, amongst this coronavirus issue, and that's obviously creating significant uncertainty. So let me just say a few words about that. I mean, I guess the first thing to say is it's difficult to estimate the impact and how this is going to play out. But let's talk about what it is that we can look at. Well, first of all, it's interesting that in some ways, China is now the example for the world of how this has played out. And what you can see is the Chinese went to great lengths to try and reduce the spread of the virus. And they took very dramatic action, closing down cities and closing down workplaces. Now, it's not clear whether that is going to be worthwhile in the developed world, given the fact that the virus is highly contagious, and the fact that the spread has already happened. So it might be that extreme reaction and shutdown of industrial facilities and workplaces and so on may not happen in the developed world. But time will tell whether that is an action that governments and companies choose to take. But what we have seen in China, given that they've been going through this virus ahead of everybody else, is that already we're beginning to see a ramp back up in production and normalization. And that's important. And actually, if you look at the stock market in China, it actually bottomed ahead of the turn in the virus rate. And as it was clear that China had got control of the spread of the virus and the number of new cases was declining, then the stock market actually performed well, performed better. And the important point here is that unlike a recession or like the financial crisis and so on, the uncertainty is much less. So what we're dealing with here is an issue that people understand will be temporary, And if you think about how that impacts behavior, it's significant. So the example would be the fiscal giveaways that we've seen, for example, in Hong Kong, where the government have just paid thousands of Hong Kong dollars into people's bank accounts. In the teeth of a financial crisis, people would choose to save that money. But if you think about what's happening at the moment, people see this as a temporary shock. They're more likely to spend that money. And the same is true of people's decisions around investment in CapEx, or if you think that you're a bank and some of the companies that you have loaned money to have been unable to make their repayments for a couple of months because of the coronavirus, you're not going to have the same stress and be calling in the loans the way that you would be in the teeth of a financial crisis, where the uncertainty could be lasting for many years. So it is a shock to markets, and we will see significant impact, particularly in the first quarter, for emerging market companies on their growth and their earnings. But we don't see that there should be lasting damage. In terms of our portfolio, we went through an exercise of looking at the supply and the demand implications for every single stock and considering the impact on the long-term thesis. And we've made no changes to our portfolio because we see that none of our companies have any impact on their long-term investment thesis. So that's enough about the market backdrop. Let's move on to talk a little bit about Martin Currie and about our fund. So you may or may not be familiar with Martin Currie, and I could just say briefly that we date back to the late 1880s, but I won't take you through every year from then till now because we'll be here for a while. So let me just say that we're international equity specialists with investors based in both Edinburgh and Melbourne. And as a firm, we have a very long history of investing in emerging markets. We were an independent company before being acquired by Legg Mason 5 years ago, and we retain our identity and our investment independence, and then we benefit from the distribution that Legg Mason bring. As it was said in the introduction, I work on the emerging market products, and that's my sole focus. So let's get straight into that and start talking about what it is that we believe in, what it is that we do. So where we see the biggest mispricing opportunity in emerging market equities is in what we would call businesses' long-term value creation potential and how that's misunderstood and underestimated by the market. So maybe to put that in more simple terms, it's the highest quality, highest return businesses in emerging markets that have a growth opportunity, that sustain their advantage over time. And those businesses that have the balance sheet that allow them to invest in that growth opportunity are consistently mispriced in emerging markets. So that's where we spend our time looking for opportunities. And we find those companies through fundamental bottom-up research, and we incorporate sustainability risks and opportunities into that research work. So, often people think of ESG or sustainability as being a negative issue, but for us, it's about understanding both the risks and the opportunities that sustainability can bring. And often in emerging markets, as regulation lags versus the developed world, you can understand the future path of where things are moving and which companies are going to be the beneficiaries of those changes in regulations or changes in social approaches. And so for us, we see this as a critical thing to understand when we're looking for the very long term. When we invest for the long term, we're looking 5 years forwards when we're investing in our companies, and the average holding period in our strategy is over 4 years. So that's how we go about finding the stock ideas. And we take those stock ideas and we put them into high conviction, stock driven portfolios. So most managers that you'll hear from will tell you that they're stock pickers. But in addition to being stock pickers, we also want to ensure that we're delivering a portfolio that is stock driven. And what that means is, in emerging markets, is that we're not looking to take large country bets, because then it's the one or two macro calls that will be determining the outcome for your portfolio rather than the quality of the stock decisions that we make. And we'll talk about that in a bit more detail later on. Next, let's focus on our team. We have a highly experienced team. Many of the people in our team have been investing in emerging markets really since the birth of the asset class. We focus our time by sector to ensure there's a steady flow of ideas coming from every sector across the emerging world, and that helps us build those balanced stock-driven portfolios. Everybody in the team has a dual role as both an analyst and a portfolio manager, and we have a very collaborative approach. We're looking to harness the collective insight, the collective intelligence of our entire team. This is quite a distinctive approach to portfolio management. It's maybe not what you're used to seeing, but certainly is widely acknowledged in in the literature and in business circles that collective decision making leads to superior outcomes. And there's actually evidence that shows that in portfolio management as well, although it doesn't remain it's not the norm, but there's clear evidence that shows the advantage. And I think that's particularly true in a situation like emerging markets, where we are covering such a broad range of countries and companies. So that's just briefly on our team. Let's move on to talk about our investment philosophy and how that flows through to the portfolio. So as we talked about earlier, we're looking to deliver high conviction portfolios. So what does that mean? It means 40 to 60 stock portfolios. We're looking for those high quality companies with robust balance sheets that have clear growth potential. So what you'll see is that our portfolio has a higher return in equity, a higher return on invested capital than the index, and we have faster growth than the index as well. We're also lower debt than the index. And we get those good attributes for close to or a slight premium to the market multiple. And that's the point about we're looking for those businesses that have those quality characteristics, those growth characteristics, but are mispriced. On the next slide here, you can just see the portfolio characteristics, and essentially what that's saying is everything that I've been talking about beforehand about the way that we managed our portfolio. So let's just move on to the sector and country exposure. As I touched on earlier, we have a focused stock list, but we want to ensure that it's the stocks that are driving the portfolio. And so what that means in practice is we don't take large country positions. You won't see our portfolio straying too far from the index at the country level, because if you do that, then basically what happens is you turn your portfolio into a single market call. So let me give you an example. If, for example, you were to go heavily overweight Brazil, and Brazil falls into recession, it doesn't matter if you own a bank, a car rental company, a dental insurer, whatever it happens to be, those companies are all going to be impacted by that recession. And we don't want that risk to be the determining outcome of the performance of our portfolio. And that's why we ensure that our country positioning remains relatively close to the index, so that the alpha opportunity that's really significant in emerging markets is coming from the stocks. We're delivering you a portfolio that's giving you broad emerging market exposure plus significant alpha. That's the opportunity that exists in emerging markets, because active fund management on average outperforms in emerging markets, and there's a big mispricing and a big alpha opportunity, and that's what we want to exploit through the stock picks that we make. On the sector side, you'll see that we do have slightly larger divergence, and that's not because we're willing to take risk there in a different way. It's just because the same risks don't exist. So let me give the example of information technology. If we have an IT service company that's helping a developed market bank develop a digital app, then it is behaving very differently to a company that's making camera modules for smartphones. And as a result, we don't see the same congregation of risk by being overweight to sector like that. But for example, consumer staples, if we were to be 20% overweight consumer staples, then we would just be making our portfolio defensive and taking a market call. And again, you would not see us make a move like that. So let's talk a little bit more about some of the stocks that we own. And you can see here on the next slide that the top 10 holdings by active weight. And there'll be some companies in here that I'm sure you'll be very familiar with, likes of a Samsung or maybe even an Alibaba. But there's also stocks in there that I'm sure you haven't heard of, like COSAN. We'll come on to talk about that a little bit later, or OTP, Central Eastern European Bank. And the point to make is what you can see here is a diverse range of different types of companies in different countries and in different sectors. And where we have conviction, you can see that we take large active positions in those businesses so that they will drive the performance of the portfolio. So let's move on to talk about some of those companies in more detail. And let's start with the the electric vehicles. So at the start of the presentation, I was talking about intellectual property that exists in emerging markets, and over half of the stocks in our portfolio are exposed to these global leaders in intellectual property. And EV batteries is a good example of that. We're seeing a significant shift take place in the car market as we're beginning this transition from combustion engine to electric vehicles. And this is a trend which is already underway, and really this year we're really hitting the tipping point. The global OEMs are going to be fined billions of euros by European governments for the carbon emissions that their fleets carry, and as a result of that, they have to get electric vehicles lined up and out to consumers in the coming year. And within the electric vehicle, one of the highest value parts of the car is the powertrain, and specifically the battery. And those batteries are made by 5 players globally. There's Panasonic in Japan, and then there's 4 emerging market companies, CATL in China, and then 3 companies in South Korea. One of those companies is LG Chemical, which we own in our portfolio. And to give you an example of the scale of what's happening here, LG Chemical have an order backlog of over $150 billion from the likes of Volkswagen, GM, and even more recently Tesla. These companies, they own the intellectual property. They have spent the R&D, they have developed these products, they have the scale of production that is unmatched by anybody else around the world. This ship has sailed. These emerging market companies will dominate this industry. And that is the point I'm making about the change that's taken place in emerging markets. When you make an investment in an emerging market, you are getting access to these companies that are the future global leaders in their industries. If we move on to the next slide, it's a completely different aspect of what's happening in emerging markets. Titan is a jewelry company in India. So on the one hand, you could say that this isn't a company that's part of that global move in terms of intellectual property. But at the same time, I could tell you that Titan uses IT in a way that most developed companies are not using. So when you go and buy these very high value items, these very high value jewelry items for a wedding, an Indian wedding, chances are today you have browsed online and looked at that product before you arrive in their store. And in some of their stores now, they can actually track what you looked at before you came into the store, such that they can present you with both those products and upsell opportunities as well. So even in a market like India, where formal retail is far less developed than it is in some of the markets that we would be familiar with, you can still see how these emerging market companies are quick to harness technology and use that technology to drive their growth. But the reason I want to tell you about Titan is to help you understand how it is that integrating ESG into our process can really help drive our investment conviction. So this is a business, as I say, that's really design-led jewelry, selling jewelry, which is a huge segment in the Indian market. But what you see is that actually about 70% of jewelry in India is in what's called the informal segment. So companies that don't pay tax, companies that are outside of that legitimate tax system. And what we've seen in India is a huge amount of regulation over the last few years that's driving consumers into the formal part of the economy, whether that's through goods and service tax, KYC around cash purchases, and most recently we've seen the introduction of hallmarking. And this is all about driving those consumers into the formal part of the economy, the part of the economy that pays tax. And as the largest player in the formal market, Titan is gaining significant market share. And this is an example where these changes around regulation and some of these changes around the social norms in India are really helping drive the growth of this business. And that's what helps us build conviction that this is a multi-year growth story. And that's just one example of how, by really looking hard at the ESG angle, you can understand your companies better and you can build conviction in your companies. And then just one more company to tell you about, which again just shows the breadth of opportunity that we have, is COSAN, which is a Brazilian energy conglomerate. In Brazil, when you go and fill your car up at the station, you're actually putting in about 20% of the fuel is made up from ethanol. There's huge sugar plantations in Brazil, and COSAN is fully integrated in that chain. It has the sugar, the ethanol production. It has the joint venture with Shell for gas stations across Brazil. It's also supplying energy to homes and even logistics as well. And so it's in some ways a kind of traditional conglomerate that maybe we're less familiar with in the developed world now. And so we saw a fantastic opportunity here, given the collection of market-leading assets that they had, given the fact that it was very tied to Brazil's economy, and we could see that it was well placed to benefit as Brazil came out of recession. And in addition to that, there was a big reorganization that's going on and still ongoing around the conglomerate structure, some of the listed businesses, and also some share buybacks, reducing the discount on the holding company. And that has been one of our best performing stocks over the last year. And so that just gives you a sense of the breadth of opportunity that we have in this portfolio, from Indian jewelry, Brazilian energy, to market leading electric vehicles. And all that, these types of stock decisions and high conviction stock picking is what's helped drive the fantastic performance that you can see on the next slide. So let me just wrap up there by saying that what you can access here is a highly distinctive approach with a combination of the way that we build our portfolios to be very stock driven, our unique team approach, and the way that we integrate ESG into our analysis. And all of that has helped drive fantastic performance in this product over the years. And so with that, I'll stop there and hopefully I'll get a chance to answer some of your questions. Thank you.
Excellent, and thank you so much for running through that, Andrew. Right, so please keep those questions coming through so we can get Andrew to answer those at the end. Now, I'm just going to cover briefly around using EMMG in a portfolio and where we see it being used in a portfolio. And I guess the first one there is really, it is going to give you, I guess, a high conviction way of targeting those genuine pockets of growth in these emerging markets by using a fund like EMMG. We also see, I guess, some of our other ETFs used for that growth in terms of our India Quality Fund, which is IIND, and also our Asian Technologies Tigers Fund in ASIA. But again, why we see EMMG as a great option is really that high conviction exposure to those countries, sectors, and companies. And that's where we see investors really using it to access that growth part of their portfolio. And of course, when we look at a portfolio, we always want to look at a well-diversified portfolio in terms of getting that asset allocation right. So this is a way of creating that diversification away from those domestic equity exposures and giving you that true diversification across those asset classes. And again, with the portfolios, it has that at least sort of quarter weighting to technology. You really are benefiting from the global technology revolution that we're seeing at the moment. And again, technology or information technology as a sector really has outperformed all other sectors in the market. And you're seeing those names that you probably already know in terms of Tencent and Samsung Semiconductors in the EMMG fund. So for the fund itself, what does that look like? And I know Andrew's already covered this in pretty good detail there, but again, you're getting a high conviction active manager and a top performing and top quartile performing fund manager, and at 1% there. And there you can see the diversification across those countries and obviously those sectors as well. So wrapping up, just I guess some key things when we look at EMMG. You're getting access to one of the fastest growing companies in the world in one trade. And again, you're getting the active management strategy and the high conviction strategy that Andrew and the portfolio managers give you through that EMMG fund at Martin Currie at that very low management fee at 1%. You know, the strategy itself is of course based off the unlisted fund with that proven track record, but now just giving you access in the form of the ETF. And again, we have that very strong and close relationship with Martin Currie and the Legg Mason team, and two leaders in obviously active fund management on the Legg Mason side, and us as an ETF fund manager to give you as investors access through the ASX. And again, this fund has an inception date on the 29th of May 2019. So things to just keep in mind, investment risks are uncertain and can be influenced by fluctuations of the share market as a whole. Diversification, an investment in EMMG should be considered as a component of a broader portfolio. Professional advice, as I mentioned at the start, we always tell our investors to seek professional financial advice before investing. And again, past performance is not an indication of future performance as well. And always read that PDF, which you can of course find that for all of our funds on our website. So I think now we'll hopefully there's a few questions there for us to answer, or for Andrew to answer. So we'll jump on those now. So the first one here, how critical is information transparency in valuing emerging market companies, Andrew?
Okay, yeah, that's a good question to ask, and I think that also goes back to this transformation that we've seen in emerging markets. So, when some of the team started investing in emerging markets, over 20 years ago, information was difficult to come by, and I think language skills were important in knowing the local landscape. But, really, so many of the businesses that we're invested in now, as I explained throughout the presentation, are really global leaders, and we've invest in businesses that have highly professional management teams. On the whole, these people speak English. They're publishing financial details in exactly the same way that developed market companies do. It might surprise you to know that, for example, even places like the Philippines, for example, their stock exchange has mandatory reporting on ESG factors and so on. So I think you might be surprised by the transformation that's taken place in disclosure levels in emerging markets. And so really the work that we do is no different to the work that our colleagues do in the developed markets in terms of the analysis and the information access.
Excellent. The other question we've got here, who do you use for your ESG research?
Okay, so we use a number of different providers, like we do for the normal fundamental research. But I guess some of the most high-profile ones you might have heard of would be MSCI, who do some ESG analysis and rankings, and ISS in terms of guidelines around voting and so on. But really, the important point is that it's us as a team that are doing that. I mean, I think almost every manager is talking today about ESG. I think the difference is that this is something that has been fully embedded in our process since inception. It's the portfolio managers, the analysts that do the ESG work. We also benefit from our head of ESG and sustainability, David Sheasby, who was a global investor for over 30 years before becoming an ESG specialist. And David sits on the PRI, for example. So he is someone who's really not just understanding what's happening in the forefront of the industry, but also driving what's happening at the forefront of the industry. And the reason it's important that we do it ourselves is, I think there's two things here. One, if you tag on an ESG person in your team, I don't think that person really can influence the portfolio manager's decision. It has to be owned by the portfolio managers and the analysts and the team themselves. And the other thing is, you can rely on external parties to provide you with some research, but you have to be careful about how you use that. Let me give you one example from our portfolio, a company that is a gas distributor in China. Now, that is a company that, if you were to look at some of the traditional ESG scoring methodologies, you would see that it scores poorly because it's a fossil fuel. And there's no doubt that gas is a fossil fuel, but that business is connecting rural homes in China with piped gas. These are households that are using coal to heat their homes, and they're using coal to cook. That has terrible outcomes for the local environment, and it has terrible outcomes for the health of the people that live in those households. So as a result, there is legislation and supportive legislation and also incentives in China to connect these households with piped gas. And so we are very comfortable investing in that company. We believe that that company has a multi-year growth story ahead of it as it connects millions and millions of households in China with piped gas. And we believe that that is absolutely on the right side of ESG, whereas if you just take your traditional rankings, that wouldn't be a stock that would be available to you. And so for us, it's critical to really understand the specifics and to do that ourselves as analysts and portfolio managers.
Fantastic, thank you for that. There's a question here on what is the currency strategy for the fund?
Sure. So, as I explained earlier, we don't take significant country position versus the index. So therefore, the exposure you get on currency is in line with the index. So we're not doing any additional hedging on that. So what that means is, as I've sort of explained throughout, is you're getting, by accessing this product, you're getting emerging market risk, if you want to call it that, or emerging market opportunity, plus you're getting the alpha that we deliver. But I mean, one thing that is worth mentioning is the Aussie dollar and the way that Aussie dollar behaves. So, you know, in our fund, we have clients in the US who have a very different experience investing in these companies than our Aussie dollar clients. So for example, in Aussie dollars, the fund was up nearly 30% last year, and even year to date, the fund is actually up because although markets have been weak, the Aussie dollar has been weak like emerging market currencies. So actually your Aussie dollar is behaving like an emerging market, and that's really dampening the risk of investing in emerging markets from an Aussie dollar investor's perspective.
Excellent. I think we've got time for one more. There's a question just on the high risk of corruption within emerging markets. How does that affect, I guess, your analysis of the companies you research?
Well, again, we have to take companies on a case-by-case basis. So, you know, things you might want to consider, and what we do still see significant state-owned companies in emerging markets. But that's not a universally bad thing. It's about understanding the specifics of the company, understanding the track record of the management, understanding the contracts in place, the related parties that the companies are working with, and so on. So that's something that we do on a case-by-case basis. But remember, many of the companies that we're investing in our portfolio are companies that are really operating in a global marketplace. They're selling to, you know, companies, other global leaders in different markets. So it's not maybe the market that you're thinking of. You know, we're not investing in a huge number of, you know, state-owned resource companies and so on, where maybe there's a track record of corruption, because of course that's something that we're very cognizant of in our quality and growth approach.
Fantastic. Thanks so much, Andrew, for covering those. There is one more question which I can cover, and that's just around the management fees for EMMG compared to other or similar funds. Look, I can't comment on other active strategies, but again, as I sort of highlighted earlier in terms of how we're seeing advisors and investors tap into these emerging markets, you can, I guess, either go through our emerging market funds like EMMG, and that's at 1%, and what you'll get in there again is that high conviction active strategy, and not, I guess, leaving you as the end investor to take conviction over what countries or companies you want to invest in, but you can access them through low-cost ETFs like we have. Again, I highlighted the India Quality Fund under IIND. That is a low-cost way of tapping into companies within that country, and again through things like our Asian Technology Tigers Fund under ASIA on the ticker code there. Again, a low-cost way of accessing some of the similar names you'll see in the EMMG fund. But again, what I say around that is obviously with EMMG you are getting a high quality active manager, ensuring that you're getting that diversified portfolio, not only in terms of companies, sectors, but also countries as well. So it's how you'd like to access that really will determine how much you're wanting to pay in terms of an MER. So I hope that answers that question there. So before we get away, I will just point out the last slide there. Again, with BetaShares, we've got a fantastic marketing team, and there's a load of content in terms of the funds we spoke about today, but also just keeping you informed. We have a heap of blogs, webinars coming up, so you'll obviously get notified those by emails. Please do sign up and register for Bassini's Bites and the other content that we have available for you as investors, and stay informed in terms of following us on Twitter, LinkedIn, and Facebook. But again, thank you so much for joining us today. We really do appreciate it, and we hope you got a lot out. And of course, thank you again for Andrew coming over all the way from Edinburgh there to join us here in Sydney today.
Thanks very much.